Hello everyone, welcome to our channel. In this video, I am going to explain you one interesting topic in portfolio management, that is Sharpe Single Index Model. Basically, the investor always likes to purchase combination of stocks that provides the highest return and lower risk. Means the investor wishes to maintain satisfactory reward to risk ratio. Any rational investor wants to invest his amount with less risk and getting more return. For that purpose, analysts paid more attention to the risk reward ratio, more attention to the return aspect of the stocks. So these days, risk has received increased attention, and analysts are providing estimates of risk as well as return. Prior to this, the Markowitz model has also explained you about the risk, return, variance, and covariance factors. But to determine the portfolio variance in the Markowitz model, we need to have number of and thousands of securities is to be done with a formidable risk. We have to maintain comparison of so many securities. For example, if there are 50 securities in portfolio, the input list will include 50 expected returns, 50 estimates of variances, and 1225 means n square minus n by 2 estimates of covariances. So basically, for comparing the all the securities, the small portfolio of 50 securities, we need to require 1325 estimates in the Markowitz mean variance model. This is the basic inherent problem which is facing by the Markowitz model. The number of inputs required and the error in assessment of estimation of correlation coefficient is very large. To avoid this, the problem with Markowitz model is the number of covariances have to be estimated. The Sharpe has developed a simplified model to analyze the portfolio. Just they require 3n plus 2 for identifying 50 securities, 152 50 into 3 150 plus 2 152 estimates are required. So this is the he assumed that the return of securities linearly related to the single index. The model itself, the name itself is single index, means only market index. It could be S&P 500 or Nasdaq, whatever it may be. You can take Nifty or BSE, Sensex, whatever. You can take the single index model. So in the absence of anything, then you can take the popular index can be treated as a surrogate for the market index, mean replacement of the market index. So William F. Sharpe simplify the calculation. This index is model for estimating the stock's return and risk. He is the Nobel laureate in 1963. The single index, again, it is a just like market index. Any movements in securities attributed to the movements in the single underlying factor, that is a market index. So that is why this model is called Sharpe Single Index Model. Right. Having said that, this would dispense the need for calculating of hundreds of covariances. So this the return of securities could be regarded as being linearly related to the single index model. Then how it works? The single index model assumes that stocks return is related to the return of market index. Like you can take any market index like S&P 500 or Nifty, BSE, whatever. The sim separates. Sim means Sharpe single index model. Separates stock risk into systematic and specific risk. So the systematic means it is basically undiversifiable risk, market risk, interest rate risk, inflation risk, all these are coming under the systematic risk. And company specific risk, it is particular to the unique to the particular stock, particular security only. This is a simplified version of Markowitz model, which is more complex and considers every possible correlation between the securities. Then the key terms used in the single index model is alpha. It is stock's abnormal return, how it outperforms or underperforms. It is overperformed or underperformed to the market. Beta, to identify the sensitivity, responsiveness to the market return, identify the systematic risk of the particular security. Then residual, random movements in securities are not accounted by the single index model. Then what do you mean by characteristics line? So characteristics line is nothing but, see, when the market index used as a replacement for other individual security, the relation of any individual security with market index can be represented in a regression line or characteristic line, that is known as the characteristic line. When the market falls dramatically, all stocks go down together. When the relation between security prospects and those of the market portfolio can be summarized by means of the characteristics line. So here I have given vertical axis RI minus RF, here excess return on portfolio. Similarly, the horizontal axis plots excess return on the market portfolio. See, here security portfolio and here total market portfolio. This is alpha, this is beta, this is the characteristic line. RM minus RF, RF in the sense risk-free rate of return, RM means the market return. So this is what we call, this is excess return. Means, what do you mean by the excess return? Means how much we are going to get excess return when compared to the risk free interest rate. If any return which you are going to get excess when compared to the risk free rate of return, that is called excess return. The difference between the expected return on the stock and the riskless or risk free rate of interest, such as the rate offered on the government security, you can take any treasury bill rate. So the excess return to beta ratio measures the additional return on security. So per unit of systematic risk or non-diversifiable risk, the systematic risk which we can't diversify, it is inevitable. This ratio provides a relation between potential risk and reward. So this is what exactly called the characteristics line in the single index model. Again, I'm going to tell you. See, whenever the relationship between the individual security with market index can be represented in the characteristic line. So alpha, it is a vertical intercept on y-axis representing on the rate of return. So the risk measured by beta, C, is the residual component not captured by above variables. See, the equation is Ri minus Rf. Ri is return on security. Rf means riskless rate of interest. Beta, Rm minus Rf plus residual item. This is a error item. So this is A means alpha. Okay, these are the different things have been given in the characteristic line. This is the graph. Then the casual observations of the stock prices over a period of time. What happens is the major concept in this is move with the market index. When the Sensex increases, all the stock prices are tend to increase. When the Sensex decreases, most of the stock prices are decreasing as well. This indicates that some underlying factors affect the market index as well as the stock prices. So the stock prices are related to the market index, then this relationship could be used as a estimate return on the stock. This is what I mentioned here. See, this is the towards that purpose, the following equation can be used for identifying the expected return on security. See, intercept the straight line alpha coefficient, beta, the return rate of return on the market index, and error term. So, as per the above equation, The return of the stock can be divided into two components: the return due to the market and return independent of the market. So, beta indicates that sensitiveness of the stock return to the changes in the market return. If, for example, beta is 1.5, means stock return is expected to increase by 1.5% when the market index return increases by 1%, and vice versa. So, likewise, beta is of 0.5 expresses that the individual stock return would change by 0.5% when there is a change of 1% in the market return. If it is a 1, indicates that market return and security return moving in tandem, in parallel way. So the estimates of beta and alpha are obtained from the regression analysis. Then the other concept in the single index model is variance of the security. Has two components: systematic risk, means also known as market risk, and unsystematic risk means it is the risk which is unique to the specific to the industry or company. The variance explained by the index referred as systematic and unsystematic risk. So the systematic risk is equal to beta into variance of the market index. Here variance means sigma square. Standard deviation means only sigma. Then coming back to the unsystematic, total variance minus systematic risk. So the total risk will be the systematic risk plus unsystematic risk. So this is what we call beta square into sigma square m plus e I square. So that is a unsystematic risk. So from this portfolio, the variance can be derived like this. So the total, the single index model will be mentioned based on the assumption that stocks vary together because of the common movement in the stock market, and there are no effects beyond the market that accounts the stock movement. So expected return, standard deviation, and covariance of the single index model represent like this. This is the mean return, variance, and covariances will be defined with the following formulas. Then the portfolio variance, the total portfolio variance will be variance of the portfolio, means expected variance of the index, variance in securities return not related to the market index, and the portion of the stock in portfolio as well. So this is called the return of the portfolio, that is that this is a variance of the portfolio, and return of the portfolio will be weighted average of the estimated return for each security in the portfolio. So this is what we call return on the portfolio return. So the alpha value is weighted average of the alpha value for its component securities using the proportion of investment in security as a weight. So here he has given the value of the alpha will be calculated like this: proportional to the investment on security, the value of alpha for security, the number of securities in the portfolio. So the value of the alpha for the portfolio will be like this: the one security, proportion of the investment, and number of securities available in the portfolio. Then you can also go for the portfolio weights, where BP is the portfolio beta. So it can be calculated like proportion of investment on security and beta. So you can call it as a portfolio beta. Then one more concept in the single model concept, after setting, after having set the systematic risk, unsystematic risk, variances, and return, then what do you mean by the corner portfolio? So here the entry or exit of any new stock in the portfolio generate a series of corner portfolios. If it is a only one stock portfolio, the stock itself is the corner portfolio. But if it is a two stock portfolio, the minimum attainable risk and the lowest return would be the corner portfolio. So when the number of stocks increases in the portfolio, the corner portfolio would be one with the lowest return and the risk combination, right? So the diagram has given like that: actual front and corner. The diagram is just discrete and combinations of several portfolio. Each number indicates number of stocks in the portfolio. When the number of stocks increases, the risk and return decline. So they are going to increase the stock, then risk will decline in this model concept. Then Sharpe's optimal portfolio. What happened is Sharpe had provided a model for the selection of appropriate stocks in the portfolio. The selection of any stock is directly related to its excess return beta ratio. Here he has given RI minus RF by beta. So RI expected return, RF return on the riskless asset or risk-free assets, beta it is changes in the rate of return on stock associated with the 1 unit change in the market return. Then this is what you call the model concept, the excess return in the difference between expected return on the stock and rate of interest as I mentioned in the earlier. So this is what we call the steps for finding of the stock. First, we need to find out the excess return beta to beta. How much excess return is nothing but the difference between expected return on the stock and the risk-free rate of interest, such as rate offered on the government security or treasury bill. That is a risk-free rate of return. Means no need to bear any risk. If you invest in the government security, no risk at all. The difference between expected return and risk-free return is known as the excess return to beta ratio for each stock under consideration first. Then rank them from the highest to lowest. Proceed to calculate CI. All stock according to the ranked under using the formula given below. The cumulated values of C start declining after particular C, and the point is taken as a cutoff point. The stock ratio is the cutoff ratio C. Here, the rank all the securities according to the excess rate and beta ratio. Calculate the cutoff rate of all individual securities. After determining the securities to be selected, what portfolio manager will do? Should find out how much should be invested in each security. The percentage of funds to be invested in each security can be estimated like this. The first expression indicates that weight on each security and then sum up to 1. The second shows the relative investment in each security. The residual variance means unsystematic risk has role in determining the amount to be invested in each security. This what we call the after selecting all these. So the portfolio will be selected based on the proportion to be invested in different securities or obtained. This is what the single index model has given optimal portfolio construction. Then, when I talk about the assumptions of the single index model, there are 5 assumptions. The first one is a linear relationship. What does it mean? It assumes the real relation between the return from the individual security and return from the market index. It means security returns can be represented as a linear function of the market return. That is the first one. Then systematic and unsystematic risk. Based on assumption that the return from security comprises two components, systematic risk which we can't diversify, unsystematic it is a unique risk, it can be diversified. Then homogeneous expectations, it summarizes all investors have the same expectations about the securities future returns and risks. It considers they are going to make investment decisions based on only on the risk return trade off of the securities. Then constant beta, the beta coefficient is constant. It measures the sensitivity of securities return to the market returns remains constant over a period of time. Thus means it implies that the relation between the security and market index is stable. Then another one assumption is no transaction cost or taxes. Means this model consider that there are no transaction costs, taxes, other functions associated with the buying and selling of securities. It, it means that it refers that all investors can freely trade securities at no charge. Then, when I talk about the uses, this can be easily identify the evolution of risk return trade off from individual securities. Investor can assess whether the security offers adequate return given its level of risk by analyzing the security returns and its systematic risk. And the second one, the model also helps the diversify the portfolio by distinguish between systematic and unsystematic risk. And the third important use and advantage of the single index model is it provides benchmark for evaluating the performance of the individual securities. Then, when I conclude this model, this is a practical and efficient approach to the portfolio selection and risk analysis, simplifying complex calculations in the Markowitz modern portfolio theory. So it is a more simplified by assuming that stock returns are primarily influenced by the single market index. The model makes risk estimation more manageable while maintaining a reasonable level of accuracy. However, the single factor, the market index, limits its ability to capture multiple economic influences on stock returns. This makes it less robust compared to the multi-factor models like arbitrage pricing theory or French model. Despite its limitations, the single index model remains valuable for all the investors and portfolio managers seeking simplified method of asset allocation and risk management, especially when dealing with the large sets of stocks. It also serves as the foundational tool for understanding systematic risk and unsystematic risk while making investments and investors' behavior. This is what exactly refers about the Sharpe Single Index Model. Thank you. Thank you for patience listening. Thank you for supporting me. Thank you for staying with me. Thank you, one and all.